Dominic D'Angelo today with O'Keefe Stevens Advisory. I'm Justin Stevens, the firm's president and co-founder. And we wanted to grab some time today to talk about just the intersection of price and value, one of the fundamental concepts for value investing. We recently read an article that was published by Howard Marks on the calculus of value, which I highly recommend everybody checks out. And it sparked a lot of interest internally with our team. We had the whole team read that article, and Dominic and I thought today would be a great opportunity just to get together and share some of our thoughts on those important subjects.
Yeah, I think there's a lot of timeless investment lessons in his article. And I think just where the market has been so far throughout this year, I think those lessons are very timely given the current market environment.
Yeah, it's interesting. Howard Marks kind of started his memo with that. It was the 25th anniversary, I believe, of the memo that Howard Marks published that kind of put him on the map. It was on Bubble Watch back in the year 2000. And he got a lot of notoriety for that article because he was really calling attention to the bubble that had formed specifically in the tech sector. In this article, he references that he did that in January, a review of that article saying we're not really in the same market, but he's kind of updated those thoughts. What did he have to say this time, Dom?
Yeah, I think a lot of his attention is focused on speculative activity that's occurring in the market. And when he talks about the price versus value, he's trying to differentiate between assets that are growing their earnings profile over time or have an earnings revenue stream or earnings stream versus assets that do not produce any earnings. Think of like art, gold. I think he was really trying to harp on the cryptocurrency space and just where that has got into in today's environment. And I think he's slowly evolving to, we are getting to a point of, we're getting to a price level that one, it doesn't throw off any earnings. So how do you value it? And two, there still has not been a real thesis behind what the use case is for Bitcoin. And I think we are just getting to a level where, you know, you're just seeing companies come public just for the sake of owning Bitcoin and not really having any fundamental purpose other than that. And I think the growth in popularity in that space is starting to become worrisome.
Absolutely. And I love that Howard Marks quoted Benjamin Graham. For those of you who don't know, Benjamin Graham's kind of the grandfather of value investing. He taught Warren Buffett. Warren Buffett worked for Benjamin Graham coming out of his schooling at Columbia. And I think it's very interesting, the distinction that is made between a speculation and an investment in the intelligent investor. So maybe just kind of delve into what's the difference, what defines an investment per value investing Benjamin Graham definition, and then how do you contrast that against a speculation, and what drives the difference in mentality between those two categories?
Yeah, I think the value investing framework is centered around, we're going to buy an asset with durable earnings power. It has some sort of business quality management team that we like, and we're buying it today at a price that represents a discount to the intrinsic value of our estimate of the business. And sure, that estimate can range greatly depending on the business you're looking at. But our goal is, if we take a conservative approach to valuing a business, we're going to try and buy that at a discount to that asset. Versus a speculation is more, it's one of those, I'm going to say it's like a greater fool theory, where you're buying it on the hopes it goes up, but you don't know why it's going to go up. And your goal in the end is to sell it to somebody else that you hope is going to buy it at a higher price than you are. And it's not a fundamental, you think the business is going to grow its earnings power or revenue stream over time. It's, I think I can sell this asset or this token or currency at a higher price for some reason in the future to somebody else. And I think when you understand which game you're playing, kind of tells you what kind of investor you are.
Right. Yeah. So all of this is to say we're looking for things that we can assign value to. That's what the primary consideration is when selecting an investment that our team is performing, is trying to value those future earnings, the assets that produce those earnings, the management team that has the skill set to compile the best configuration at the company level. I think that was an important thing that I gleaned from that article was, we're really looking for managers who find synergy, right? So the sum of all the parts and almost all businesses should be greater than the individual parts themselves in terms of producing earnings.
Yeah.
Whereas if you're contrasting that against a speculation, Howard Marks actually assigns no value to the idea that you just hang on to something with the hope that somebody else buys it from you at a higher price. And also that person who's buying it from you at that higher price is hoping to do the exact same thing. And so we've seen this, time and time again. There's a great little book out there, the history of euphoria, I believe it was called, John Kenneth Galbraith's book. And it goes through all those timeless episodes. It's hard to say, is that cryptocurrency, is that Bitcoin today? But we certainly know that there is some kind of rhyming to that scheme, in that the crypto market doesn't produce anything of value that we could say, hey, the future benefit to the shareholder will be this because earnings are coming from that asset. Correct?
Correct. Yep. Yeah. So, when there's no prospect of us getting a dividend or some sort of cash flow stream in the future, then I don't know how you assign a value to the asset or whatever it is you are looking to come up with a correct price or value for. It's more of just it's basically sort of like an auction market, like how high is somebody willing to pay for it? And then that's technically your price or value, but is that the actual underlying value of the business is something else?
So value, this is an important distinction too. Value is very much in the eye of the beholder, right? Because every day market participants, buyers and sellers of stocks, are showing up and casting votes on what they think is valuable. And that could come from any number of different areas of value, right? It could be the growth of those future earnings. It could be the tangible assets that the business holds. So today, in today's market environment, what are we seeing on our valuation? How are most other investors assigning value in today's market?
I think there is a lot shorter time frame, a lot more of the voting machine going on per se, where the moves that I would say I'm seeing on a daily, weekly, monthly basis, and specifically around earnings season, appear so far outsized because people and investors, speculators, are trying to position themselves basically with, I think this fund has this thesis, but if it doesn't come through, I know they're going to sell it. It's really, they're just trying to play a game of, are the next quarter's results going to beat what people think? And then there's like a second order effect of, do people already know that they're going to beat what people think? So therefore I should short the stock. I think there's just a lot of short-term mentality going on today. And if you look at, I'm going to say any stock over the last year, the 52-week high low it seems so much wider than what I can recall in a period that I'm going to say there's uncertainty, but I think there's always periods of uncertainty. There's always something going on. And it just seems a lot wider of a range, even though a lot of these businesses still are fundamentally very solid. The value of their business is not changing 50% on a given, quarter or 6 month time period. And I think that's an opportunity for the investors that are doing the research and not playing that short-term game that have the opportunity over the long term.
Sure. So while valuation is very much in the eye of the beholder, it's a very subjective thing. Price is very concrete, right? We show up every day, we know what the price of something is. And there's to your point, a big disparity in the prices of assets today. We have seen in particular the largest companies in the United States begin trading at very, very high prices. Can you talk a little bit about that and just what you see happening, why that's happening today,
Yeah.
and what our opinion is on the future of that?
Yeah. So it's interesting. The Mag 7, your Google, Apple, Alpha, Facebook, Meta, trading somewhere around 30 plus times next year's earnings, which for companies that are some of the greatest businesses that we have ever seen is not unreasonable. That is, if you look on I'm going to say on a backward looking basis, these are some of the greatest businesses we've ever seen. We are going through a weird or different transition where historically these businesses were on average very capital light. They didn't require that much reinvestment back into the business to maintain and grow their earnings power. So all their free cash flow that they generated, they could go out and make an acquisition, they could pay out a dividend, they could repurchase shares. They didn't have to spend a lot on CapEx to grow their business. What's interesting today is that is not what we're seeing anymore. These capital light businesses are now spending, I'm going to say, on the order of magnitude of somewhere around $500 billion in capital in 2025, and that's expected to grow into 2026. And just that amount of capital spending, I don't want to say it doesn't no longer make them a capital light business, but it's no longer going to be a business that has these very high return on invested capital metrics, especially when you think about what the return on that capital spending is. We're in a period where this is basically referencing AI, their AI CapEx spend. AI is so new, and I use it every day. I think it's unbelievable. I don't know how they have any sense of what the return on their capital spending is going to be. And so if you think about what drives a price earnings multiple, what's the correct valuation somebody should pay, it's a function of how confident are you in the future earnings of the company, what's that return on invested capital figure, and their moat, things like that. When you're going from a period of they're the greatest business in the world, deserve a very high multiple, to you're now going to a period of they're spending more and the return on that spending is uncertain, in theory that should drive the valuations lower because the range of outcomes in the future is much wider. If they're spending $500 billion and it turns out, they're going to generate, call it $100 million $100 million or $100 billion, sorry, of profit on that spending, that's one thing. That's we'll just call it a 20% return on investment. There's also a chance it's 50 billion. There's also a chance it's 500 billion a year in free cash flow they generate. There's maybe it's 750 billion, but you're also getting to a point where the numbers that they are spending are so large that to drive the amount of free cash flow that they need to generate on this spending, we are just getting to very, very large numbers that require other companies to really start adopting AI in a fast way. And so I think when your range of outcomes gets wider, in theory, your valuation should become lower. And I think that's your general risk in the market today, is that you've got uncertainty on what the return on invested capital is. If it comes in a little worse than what people are estimating, it's not like these are cheap valuations and they are totally disrupting their previous business model. So you got companies trading at 33 times earnings. What's the right multiple? I don't know if it's 25, I don't know if it's 20, but it's unlikely to be where they are today.
It's interesting because as prices go up, right, the attractiveness of future returns should be going down, correct? Right. And as prices go down, the attractiveness of future returns. Do you think that fundamental truth, as we would know it in investing, do you think that there are other analysts out there that have kind of scrapped that idea and are just betting on growth? The fastest growing assets are going to continue to be the fastest growing assets in the future, and it's this winner take all environment.
I think we are seeing a lot of analysts and companies saying, I can't be the one to miss out on this opportunity, and therefore either spending money on projects that have uncertain return economics to them, or analysts saying you need to own these companies because if I don't recommend a buy to them and they do turn out to be the handful of winners, then I can't really be trusted going forward. So it's one of those, it's very close to the fear of missing out. Like, I can't be the one to not spend. I can't be the one to not recommend this stock in case it is the one that works out.
So if I were to summarize, there is a lack of discipline
Yeah.
in the capital allocation market today. Both capital allocators on the businesses that we want to own as investors, but also in the investment community, the discipline of sticking to a tried and true strategy like a value investing strategy that focuses on price and the intersection of value. A lot of those, the fundamentals are being kind of thrown to the wind, and there's a lack of caution today, correct?
Yeah, I agree with that. I think if you own any of these heavily spending companies, your hope right now is that the management team has a much better understanding of what they're doing than what is available to market participants. We've owned NVIDIA for a long time now, and a lot of that stems because we have trusted Jensen this entire time and continue to trust him. I think if you own any of the other companies, you have to have a lot of confidence in the management team and trust that their ability to assess what the best use of capital is where they're deploying it, and that they have line of sight to some sort of economic return on that spending.
And there's another great book that we would point to, The Outsiders, which I know you've read. We've sent that book out to a number of clients and are happy to send it to others as well. Really talks about that role of the outsider CEO, the CEO who stood out. There was 8 examples of just wonderful capital allocators, people who used the resources, the free cash flows that were being generated by the company to make very sound decisions, whether that was buying back stock, paying out dividends to shareholders, investing in research and development, paying down debt, right? Issuing new stock, all these different things that a CEO can do. Those are ultimately the decisions that we're making. We're hiring the CEO to make for us. And it's imperative from our vantage point as researchers that we find CEOs who are very disciplined in that approach. You listen to a lot of calls, obviously all the ones of the companies we hold, but also to a number of other companies. Do you think that there is, I don't know, some betting or gambling going on in the capital allocation world right now?
Again, from an outsider's perspective, not knowing what the management teams have internally, I think at the large companies, there has to be some gambling going on, because you don't know what other companies are going to be spending on AI in the future. Is every company going to totally replace their assembly line today to automate it with robots in 5 years? And is the capital there? Is the technology, the production, is that all there to warrant the spending? So I think there is certainly a winner take most mentality right now going on, which is driving a lot of the spending. And if the potential upside is there, then it's not gambling. Like Buffett always says, if you give him a 55% chance to make something right, but you give him good odds on it, he'll take the bet every time. And so that's kind of where it is today. If the upside, if the market potential is there for these companies, then they therefore have to go after it. On the other side, I think once you get past the large tech companies, it seems like a lot of companies are resorting to just doing buybacks or paying out dividends, and the capital allocation decisions. I haven't seen a lot of gambling or speculative activity on that capital allocation side for the smaller companies. I think everybody's trying to be relatively disciplined today. I think we're seeing some companies just hold a little more cash than what they're normally doing, just to sort of fortify their balance sheet. But that's all I've seen.
Is there any areas in today's market where you're seeing, we call it the unloved and unwanted bin internally, right? Where you're seeing just major dislocations between what we think the value of something is and the price that people are willing. Is anything on sale I should say.
It is becoming harder and harder to find ideas that are trading at cheap valuations. When Peter O'Keefe, CIO, and I talked, the only area of the market that is, I'm going to say, down significantly, or there's a large drop in value, is the healthcare space because of what's going on at some of the large healthcare players, and the energy space where energy prices are somewhat lower. Besides that, everything else seems like it's certainly not trading at a valuation that's below their long-term average. They're at or above, on average, their long-term valuations. And I would just say when we are struggling to find ideas, it likely means that the return prospects of a lot of securities are not as good as they were, 12 months, a year or two before. Might make sense to have a little more reserves than what we typically have, because if we're not finding good ideas and we can still get decent returns in either like the fixed income or money market space, why we're not going to speculate on a number going up. So it's, in our opinion, probably better to take some and put it on the sidelines, because at some point, we don't know when, don't know why, markets will pull back at some point. Companies that are expensive today will be cheap. And not that this is 1999, 2000, but there were some incredible businesses that went on sale because what people thought their business model was turned out to not be the case, but still had long-term success in the end. So we just want to be in a position where if something happens, that we have the opportunity to take advantage of it, and that we don't have to sell other securities that are also going to decline in price. Because when the markets go down, typically doesn't matter if you're in an industrial name, consumer, tech, correlations go to one, just everything seems to go down. So we just want to be a little more prepared, I would say, in case something happens, and be prepared.
It's interesting because, and on my side, where we're talking with the financial planning clients of the firm who ultimately become the investment management clients, I think it's really nice to marry those two conversations together. I always use the analogy of the capacitor. It's like an electrical current, right? In the markets, they're going up and down. There's a positive charge in the long run, but we go through these punctuated periods where we hit troughs, and then sometimes we're in peaks. And it's really tough to know at any given point until you have the observation in retrospect of where was the peak, where was the trough. But if I hear you right, it's becoming increasingly easier to say, hey, we're nearing market tops today. Now, could that go on for another 2 years, 2 months, 2 weeks? We have absolutely no ability to call that. But when we start to get these feelings, how do we behave, right? And I think the behavior that I'm hearing you say is it's prudent when you've had a multi-year bull market rally to have ample cash reserves on the sidelines. And what we do is we pair that up against our clients' future cash needs in the portfolio. And so usually we want to have retirees somewhere between 1 and 3 years of liquidity in their portfolio. And today I think it's fair to say we've got, at least the 2 years liquidity set aside, but in some instances, we're starting to even elevate that to higher levels. And the point being that when we do experience that next, steep roller coaster ride down in the markets, we want to be able to act with confidence and conviction that we know things are now on sale. And if you have a 4-year cash reserve, well, we don't need 4 years to see this recover. We could take a couple of years of that cash and be buyers in a market and actually experience much more benefit from the market recovery when it does happen.
Yeah, I think the interesting thing, assuming it does happen, which we haven't seen a prolonged downturn since 2009 or so. And so you've got basically 16 years since we have had a prolonged downturn in the market. A lot of market participants today have never experienced something like that in their career. You might think you're prepared for something like that, but until it actually happens, you don't know how you're going to react. that probably means more volatility in the market, probably means more opportunities for the long-term investors.
Yeah. And so on that same subject, let's talk a little bit about just what's happened to the actual market in terms of participation over those last 16 years. And specifically what I'm talking about is the movement towards indexing and how that kind of has a hand in what you're talking about, which is how do investors behave when we do finally hit that big bear market event.
Yeah, we've seen such a rotation from actively managed, so individuals picking what stocks or what securities go into a portfolio versus outsourcing that to BlackRock, S&P, where they just it's an index, and based on whatever criteria it is that they have, choose what securities go into, like the S&P 500, the Dow Jones, the NASDAQ. Over the past 15, 16 years, we've seen a significant shift from actively picking stocks to we're going to outsource, we're going to go passive index investing. And there are fewer and fewer participants consciously making the decision of what the correct valuation of the business, of what the stock should be. And that trend is, until something changes, that trend is probably not going to change. You're going to see more capital continue to flow towards passive. The risk is everybody's in passive. What if some people wanted to actually start, managing their portfolio, or if they wanted to get out, the concentration in the securities in the top, I think it's top 7 securities in the S&P 500 is somewhere around 35% of clients of people's portfolios if they own the SPY, just the S&P 500 ETF. They think they're getting diversification, but those 7 stocks are all highly correlated, very intertwined with each other. And so if something bad happens to one, it's likely happening to another. And you just wonder what the trickle down kind of effects are of this continued shift to people outsourcing that decision. And we actively manage securities because we think there's opportunities. At some point, I think we probably gone a little too far in outsourcing the decisions, and I think that at some point there should be a recalibration back to actively managed.
So in addition to this shift into passive managed indexation, you've got lots of concepts being thrown into the mix there. Direct indexing. One of the things Howard Marks talks about in his article that I find fascinating, it's not really an area that we've touched directly. We have some indirect exposure to it, but the private markets have seen massive flows of retail investor capital into them, which has really driven up the price for non-traded private assets, which many of those historically would have entered the public markets and have not yet entered the public markets because there's such a huge demand in the private markets for those assets. Can you talk a little bit about what you're seeing in the private capital markets?
Yeah, there has been so much institutional money over the past 20 years that's flowed into private equity, private credit, because of the strong returns that they generated, between 85 and the early 2000s. That was when private equity is just, getting going. And the model of buy an asset, put a lot of leverage on it, improve it, and then thereafter sell it or take it public and return the cash to investors. It worked really well. When you go from, I'll just say 10, 20, 30 billion of assets into an asset class, to funds these days are raising north of 10, 20 billion dollars. Just the amount of capital that has flowed into private credit, private equity, it's impossible to generate the returns that they previously generated when there's so much capital going after every deal. I think the really interesting thing is the markets, by and large, are very open. The credit market, it has spreads. So the 10-year, I'll just call it the 10-year treasury versus what an investment grade corporate bond is trading at. The spread on yield is somewhere around 80 basis points. So if the 10-year treasury is at 4%, a investment grade 10-year bond yields somewhere around 4.8%. And looking back historically, that is a very tight spread. Normally it's it's higher. I don't know if it's 1.2, 1.3%.
You get
Some number
paid
higher.
for the risk, right?
Exactly. You're getting compensated for the risk. Exactly. Today you're not getting a lot of compensation for going to investment grade bonds versus buying a 10-year treasury. So the capital markets are, I'm going to say, very open. Credit spreads are very tight. And typically that's an environment where you would see a lot of IPOs or private equity companies take their companies public. That is just like, that's not what we've seen over the past couple of years. And I would say there has to be a reason behind it. If their investors are looking for capital to be returned to them. They're not just in this, hey, we're going to give KKR or Carlyle Group $10 billion. We don't ever want to see a return on that money. You guys keep it invested forever. They're looking to get capital back to deploy it in other opportunities. So why is it that we have not seen these companies taken public? I think the answer is likely these guys generate fees based on the valuations that they mark the companies at. If they take them public, they now have to actually mark them to what the market is willing to pay for them. And if that's lower, that hurts their next round of fundraising, which just it starts a cascading effect of this company got lowered in our portfolio. So that means that company has to get marked lower. And it's just it's a vicious cycle of nobody wants to take that lower mark on their portfolio so they can keep the fee stream going, so they can keep the fundraising going. And at some point that stops. At some point, investors look for their return that they said that they've gotten over the past decade in these funds.
Well, it's important to study your history in investing, and it's eerily reminiscent of the leverage buyout era, which I don't think I've not heard many other people talk about this, and I'm not sure where exactly the concept came to light for me, but private equity is essentially leverage buyout. It's just being done in the private capital markets instead of the public markets. And it's almost always with borrowed money. And so you talk about this cascading effect, and things that that leverage buyout market collapse really hit Wall Street, but the private capital market leverage buyout collapse would have a major impact on Main Street, as many of these private businesses are. We see it every day. I mean, there's mom and pop shop businesses that are being gobbled up by private equity, and the deals are very lucrative, but are they prudent, and are they financially sound? And when the music stops and everybody's scrambling to find the last chair, who gets left holding the bag, right?
Yep, exactly.
So not to scare everybody and say, hey, there's this enormous ballooning risk in our markets, but it's certainly something to be conscious of, and just take an appraisal of where are we today and what does prudent decision making look like when we see these things happen.
There's talk about opening up the private equity market to individual shareholders. I don't. It sounds like they're going to try and take their funds public and allow basically you and I to buy a portion of that fund at some valuation. I'll just say typically when you see companies trying to pitch certain investment vehicles to the public, it's probably their last resort that they're trying to do. So,
right. Well, fund of funds and publicly traded. I mean, there's lots of mutual funds that act as fund of funds with daily liquidity in the private markets. And again, if Wall Street's making products around it, it's usually not a great sign.
Yeah.
In terms of the longevity of that business. If there's this new thing that's happening, we tend to not avoid that entirely, but just approach it with an eye of skepticism.
Yeah.
And very much a let's wait and see until this is proven.
Yeah. I would just say in total, we've got the speculative activity that I think is occurring in some spaces. We've got a lot of spending with unknown return economics. We've got valuations that are relatively high across the board. It's not one individual data point that will lead to some sort of decision making, but it's when we see several conforming data points that are all flashing the same signal. It's again, you said it before. It's not that I'm worried today. It's not that I think something might happen tomorrow. Just the setup is not the most attractive today. And so when that's the case, it's there are certain decisions that have to be made. In his memo, he said he called it like the five things you can do when you're worried about the future. You can like sell it all, you can short the market, you can de-risk the portfolio, purchase more defensive companies, things like that. And then he says, I'm never going to short the market outright because the market can go up longer than you think. Maybe you can pare back some defensive holdings, maybe you can rotate the portfolio into more defensive holdings. Just, I think a more cautious outlook is probably, I would say, what we're trying to convey. Not that we think the sky or the world is going to end tomorrow. Just there are some things that we think are probably underappreciated today, some risks that are underappreciated today that the market may not be worried about.
And I have this conversation often. Another Warren Buffett, betting against the American economic engine is never something I'm personally going to do. I think we have maybe not the most ideal setup, but definitely the best setup with the most momentum that exists today in the United States. And there are an enormous amount of companies and individuals that will benefit from that long-term trend that is so well. Those tracks are very greased and continuing to operate, but we will have some pretty serious hiccups along the way. I think it's fair to point out being early and being wrong look very similar in these situations. So this is nothing that we're not going to, bet the farm on one decision and say, hey, this is exactly what we think is going to happen. But acting prudent and being good stewards of our customers' financial capital is the name of the game. And what we choose to do with our own dollars should mirror what we do with our client dollars. And I think, I'm sitting here and saying, hey, I can't wait for the market to pull back so that I can buy assets that I know are trading at discounted prices. And I haven't had that opportunity in quite some time. I've been buying right along, don't get me wrong, but having a big reserve of capital to be able to invest when that next, you want to swing when the pitch is fat and down the middle. Today, we don't have a pitch that's fat and down the middle. We have, an unlimited amount of strikes, though, that we can take. And it would seem the best thing is to just wait until it's a sure thing. Dom, anything else you would want to add that we didn't talk about?
I don't think so. I think, those 7 companies that we've referenced in the past, they're still some of the greatest companies. I think the fact that they're all US based is an incredible thing to watch. I think being a part of what's going on the technology advancement side is, whether the investment works out or not, the advancements in civilization and the productivity enhancements, the things that the things that I'm able to do just on the investment side today are so much better than what they were two years ago. It's very fun to be a part of. I'm just glad I don't have to make the decisions on where I have to spend the capital at these companies, because there's just such a wide range of outcomes on what is going to happen over the next 5-10 years that I'm glad I'll be able to watch it, be a part of the technology advancement. Glad I don't have to make those decisions, though.
Yeah. And then the other thing I'll add too is that, owning those companies is one way to play that game, but almost every other industry that we invest in is going to have similar benefits as that technology becomes interwoven in those business processes. So it's a very fun time to invest, and the future looks very bright. As I said, I would not bet against the future, and we still have optimism is our guiding principle here. But it does make sense to pay attention to price and value, which is what this whole conversation was about. So thank you for sharing some insights on that. We will drop some links into the description of this video, specifically that calculus of value memo that Howard Marks put out. I think it'd be a great thing if you found this valuable to go check out what Howard Marks has to say about that. He has an incredibly clear way of articulating some very complex subjects. And I personally think it was one of the best pieces that's been written on value investing in the last few years that I've read. All right. Thanks for your time, Dom.
Absolutely. Thanks, Justin.
All right.